All right. Happy Friday, everybody. Happy Friday to all you magnificent melon heads. It's my favorite time of the week, my Friday afternoon live stream where we get to wrap up the whole week talking to you fine people about everything going on in the world of finance and economics. And it has been a week, hasn't it? Boy, has it been a week. Worries about the Bank of Japan, the Fitch downgrade dominating the news cycle. There's something going on in crypto right now. I don't know what it was, but I just caught wind of it right before we went live. My initial hot take of it, it looks like Changpeng Zhou, a.k.a. CZ Binance, is going Godzilla on all of his rivals in the industry, kind of like he did to Sam Bankman-Fried that led to the FTX blow up. Going to keep an eye on that story. We'll see if anything develops. It hasn't really moved any crypto prices yet. But there are some big whales in the crypto industry that are just waging war on each other. Crypto, Tether is involved, Coinbase is involved, Binance is involved, Kraken is involved, Deltec Bank in the Bahamas. Could be messy or it could be nothing. All right. But that's happening kind of behind the scenes right now. But what I really want to talk about today is the return of Burr. Yes, Jerome Powell and his infamous money printer. They're coming back. I can't tell you when. But it is a mathematical certainty that it is coming back. We will once again see Burr. We will see ZIRP, which is zero interest rate policy. If you don't, habla Federal Reserve. It's a mathematical certainty, guys. What we are watching is a debt spiral happening in real time, courtesy of the United States. And look, it's, okay, the government debt spending, the government has a spending and a borrowing problem. Look, we've all been living with that our whole lives. It's nothing new, right? Yawn, move on. Well, that is why nobody is really, just Fitch and, people who live in the finance space, nobody realizes what a unbelievably exponential turn this phenomenon has taken in just the last couple of months, really since the debt ceiling was suspended. It has been unbelievable to watch how as soon as they suspended the debt ceiling and, we're all clear through the next election, hundreds of billions a month, even close to trillions a month, has been borrowed. And they just announced earlier this week, that they have plans to borrow even trillions more. Meanwhile, the interest expense that the government is paying is going vertical. Folks, at our current pace, it is a mathematical certainty that within a short time frame, I'm talking maybe a few years, the US government will be entirely insolvent. Interest on the national debt will exceed all revenue from taxes. That's coming. And so that obviously is so unsustainable, and there would be so much demand for debt and so much demand for dollars and so much borrowing that it would just send interest rates so high that it would bankrupt the government. And of course, the government can't afford that. The government can't afford a deflationary debt spiral. The government can't afford to watch companies go bankrupt and watch money go up in smoke, because when companies declare bankruptcy and the debt is defaulted on, money becomes scarce. Money's destroyed that way. Then you have deflation, something we've been calling for on this channel for a long time. Deflation is coming. On our current pace, we will see a deflationary collapse very soon. But of course, the government, who is by extension through the Federal Reserve in charge of the money supply, they can't tolerate deflation because they have $32 trillion in debt. And the people who suffer the most in a deflationary environment, besides the people who lose their jobs and whose houses become less valuable, and people who watch their retirements go up in smoke, but the people who really lose are the people who owe. And ain't nobody owes more than Uncle Sam. 32 trillion, 32 and a half, and counting, but who's counting? So they will not allow deflation, at least not for very long. And I've been saying since I started this channel that they will absolutely turn the money printers on again. And people were saying, how could they do that? Inflation was so high. Obviously, they won't do that. Jack, you're crazy. And I said, no, they're going to turn the money printers back on because we beg them to. That's why they're going to do it. And I think that's getting closer, and it's speeding up. We're accelerating toward that, not slowing down. And I just want to say thank you so much to Mr. Jim Watari. Before we even went live, Jim Atari says, here's some Burr for you. Well, thank you very much, Jim. I appreciate the super chat and the laugh and the support of the channel. And by the way, guys, if you don't know what Burr is the sound Jerome Powell's money printer makes as he is easing quantitatively. or basically just printing money. And they don't even really do that anymore. They don't actually print it. They just type on their keyboard and create it digitally. They don't even bother to go through the process of actually printing the money. Thanks a lot, Jim. I appreciate that, sir. And with that, guys, let's shrink my big melon of a head. And we need to do two things when we shrink my big melon head. First, we got to shrink that like button, too, while we're at it, because it really does help for the YouTube algorithm. It helps me out a lot. Smash that like button for me, guys. It really helps out. And if you're new here, won't you please subscribe to the channel while we're here? We do this live stream every week. We also do a morning update live every morning, as well as some regular videos. And I've got my man, Mish the Mod, the master of the Mystic Arts, is in the house. How are we doing today, Mish?
Man, I'm doing so good. The weather here is getting so much better. I don't feel like I'm cooking.
You are no longer trapped under the heat dome. I heard so much about the heat dome over the last few weeks. It's finally broken. Well, check this out, Mish. Look at the Fear Greed Index, 72. Looks like we were on the cusp of extreme greed this morning. We were at 74. We hit up into extreme greed territory at 75 for a little while, but something put the fear back into the markets sometime around 2 o'clock this afternoon, 1400 Eastern time. I don't know what it was, but here we go. 1355. I guess you could say it started at about 145, 150 this afternoon Eastern time. The indexes started selling off, and they kept doing it. We were riding high on that jobs report, on that Goldilocks jobs report. By the way, I said CNBC was going to call it a Goldilocks jobs report. I was way off. It was Wall Street Journal said it. Way off. The financial press thinks with a hive mind. They're so predictably unoriginal. But the S&P right now is down 20 points or 0.46%, giving up all the gains on that jobs report. That was so bad it was good. Because talked about in the morning live stream today, we're back into that ridiculous, inverse, bizarro Fed reality because we don't have a free and a fair market. No, we have a Fed market. That good news is bad news because good news means Fed, or bad news means Fed go burr, and therefore it's good news for asset prices. This is mentally exhausting, I know. And likewise, bad news or good news is actually bad news because good news means the Fed maybe won't go burr anytime soon. Maybe the Fed will tighten, and that would be bad for asset prices. So the economy and the stock market are diametrically opposed in their interests right now. Stock market is selling off since early this afternoon. And the Dow doesn't look so good either, down 141 points or 0.4%, trading at 35,074, selling off into the close. And the NASDAQ is joining in the sell-off, 13,928 on the NASDAQ, down 32 points or 0.23%. And along with this sell-off that started right around 1:45, 1:50 p.m. Eastern time today, we also saw a move in the DXY, the US dollar index, the strength of the dollar as measured against other currencies. Here's a big drop in the Dixie this morning on that jobs report, right? This is the market saying, oh, bad news is good news. The Fed is going to be more dovish, less aggressive, and so the value of the dollar started to weaken. But then something happened right around 1345 today, 1350. The dollar started to strengthen. I went looking. I could not find it. There was no speech from some Fed hawk. I cannot find any event. Let me know down in the comment, guys. What do you think caused this? Somewhere around 150, 145 to 2 o'clock this afternoon, something happened that turned markets. Mish and I were talking before we went live. We cannot find the initiating event, but something sure as heck happened. And thank you very much to the Warrior Lady for your super chat. I appreciate that very much, Warrior Lady. She says, I will let next week's higher CPI do the talking for me. Ooh, sounds like a challenge. You know, Warrior Lady, I think it was you that mentioned this in a comment a few weeks ago, or maybe it was last week's live stream. You mentioned the base effect on CPI, and you made me do a double take. I went back and looked, and sure enough, there is a little bit of a base effect coming into play here. While I have Warrior Lady here, let's bring up the Consumer Price Index on the St. Louis Fed. We're doing this on the fly here. All right, so let's look at the Consumer Price Index. Is this? Oh, no, that's owner's equivalent rent. Hang on.
I was going to say, that doesn't look right.
Yeah. Let's see. Not owner's equivalent rent. Let's just do Consumer Price Index. We're going to have to Google this thing. Here we go. Where's the St. Louis Fed website for CPI? Here we go. All items. U.S. city average. This is, forget what the year-over-year change number. This is the actual Consumer Price Index itself. When you guys hear CPI was 4% or 3%, they're talking about the year-over-year change in this chart. Okay, so what we're going to do is we're going to go back to about a little over a year ago because I want to talk about the base effect that Warrior Lady brought up. Sorry, got an inch closer. Okay. So here was the consumer price index and what happened about a year ago, right? So we have the consumer price index that's going to be reported in August. It's going to be the July CPI. So let's go back and let's look at July and June and August of 2022. Now here's June of 22, here's July, and here's August. Now you'll notice these three data points were all pretty similar. We had kind of a breather in the CPI last summer. Now the year-over-year numbers continued to go up, but the index itself didn't rise as much in June, July, and August. We had this 3-month kind of pause in CPI. Now, that's interesting because the headline number is the year-over-year change. Well, you can see the index has been going up. Prices are still rising. I just want to mention that, guys. We do still have inflation. We just have much lower inflation than we used to have. But the prices are still rising. But as the prices are rising, the year-ago number that we're comparing to is not rising. And therefore, the base effect alone could drive CPI higher next month. And Warrior Lady, let me know in the comments if you think I'm off base here. Is that what you're referring to, that the base effect in and of itself is going to drive CPI higher? If that's the case, that might be a shocker because a lot of people are expecting a continuation of the trend lower. We might not get that. The base effect is working against us. So if so, Warrior Lady called it before anybody, and she would, in fact, get the much coveted cookies in the live chat. Thank you very much, Warrior Lady. I appreciate the super chat and the support of the channel. And let's go back to my charts here. Where were we? We were talking about the DXY, and let's look at the DXY because the DXY, we're going to zoom in now. This is going back to about the beginning of the month. You'll see with this sell-off in the dollar today, with this weakening, which right now it's regaining some of that, but we lost the 50-day moving average on the US dollar, something that we had just retaken a few days ago. Just what was it, Wednesday, we recaptured the 50-day moving average. We have failed that first retest of the moving average on the DXY. Now, the support for the DXY is right here around 101, this blue line that I drew before, that area. If you look, that was support the last few times we hit that. We held it. We broke below on the back of the jobs report that we got last month. We've been climbing back ever since. And then, of course, the dollar spiked this week on that news of the Fitch downgrade and all the happenings at the Bank of Japan. So watch that 101 level and watch that 50-day moving average in the dollar. Let's look at what's going on in the bond market because it has been a day in the bond market. The 30-year average, 4.19, 30-year yield is at 4.19. That's down almost 14 basis points today. Big drop in bond yields. Now, guys, remember the inverse relationship between bond yields and bond prices. So when you see yields dropping, that's bond prices going up. People are buying bonds like crazy today. Especially they're buying the long end of the yield curve. Now, historically, when you see people piling into the long end of the yield curve, that's usually referred to as a flight to safety. I'm not sure that's really what's going on today because we don't have an accompanying move in gold and silver that I would expect along with that flight to safety. But we are seeing yields dropping right now, and that is typically a hallmark of a panic in markets. The 10-year is also down almost 15 basis points at 4.04. The 2-year down 10, almost 11 bips, 4.78. The 1 month still holding strong at 5.38, where it's held there by the Fed's overnight rate. Now, let's look at the long-term chart of the U.S. 10-year yield right now. Broke below that resistance line, or I should say that support line that was previously resistance. I've been drawing this for a while now. We had that cup and handle pattern right here. I thought we completed it. We broke out above it, but today we failed the first retest of that line. So yields heading lower right now, 4.04 and counting. I'm kind of surprised that throughout the day, as we've been watching this turnaround, as we've been watching the Dixie strengthen for the last hour or two, and as we've been watching the indexes sell off, we haven't seen the move in yields reverse. I would have expected yields to start moving higher on that news, but that hasn't happened. So things happening right now. It's not entirely clear what that is, but something changed right around 2 o'clock, 1:45 this afternoon. Speaking of commodities and gold and silver, let's look at those. Gold is up $8 right now, or 0.4%. Again, with a big move down in yields, I'm very surprised not to see a bigger move in gold right now. Gold usually likes lower interest rates because gold competes with bonds in the safety trade, and when yields are moving lower, gold, which yields nothing, looks more competitive. So a move down in the 10-year like this, you'd expect to see gold and silver rallying. We're not getting that. That's why I'm kind of scratching my head this morning or this afternoon at what we're seeing. Silver is down also 23.69 for silver, down about a penny. Not a big thing. And speaking of silver, let's talk about the Silver Symposium, the Stock Pulse Silver Symposium on September 29th and October 1st. Yours truly and his truly, Mr. Mish, we will both be at the Silver Symposium in Vegas. I'm not going to say it. I'm not going to quote Swingers. Every time somebody says Vegas, they quote that movie, and I'm not going to do it. I promised myself I wouldn't. But I am going to be at Caesar's Palace. Big upgrade in the venue this year for the Silver Symposium. Looking forward to that on September 29th and October 1st. Guys, there is an affiliate link in the description down below. If you haven't gotten your tickets already, you use that link, you will get 10% off your tickets. Let's just talk a little bit about who is going to be at this event. There is the man, the economic ninja himself will be there. We've got Dan from I Allegedly, who always has a good one for you today. I'm sure he'll have a good one for you again at the Silver Symposium. Who else do we have going to be there? Joe Brown from Heresy Financial. And I tell you, every time Joe Brown puts out a video, I learn something. He is just one of the most educational channels on YouTube that there is. Joe, he's a speed reader. He is just an absolute Johnny Five, craves more input, consumer of knowledge, and he loves to share it with us. He is going to be at the Silver Symposium also. Check out Heresy Financial. Rob Keens from Gold Silver Pros is going to be there. There's Patrick Hakeem from the Economic Preppers and the Sat Pulse channel also. And my buddy Chris Taylor from Financial Prepper. We're all going to be at this event. So, guys, come on out to Vegas, Caesar's Palace. If you're looking for an excuse to take a vacation, this is a pretty good one. And when you're there, when you see us, just walk right up to us and say hi. Let's have a beer. Let's talk finance. Let's talk economics in person. I've gone to a couple of these now, and I always have such a blast doing these events. These are so much fun. You meet such amazing people doing this. So please join me at the Silver Symposium on September 29th. Let's go back to the commodities board real quick because we've got a big move today in crude oil, 82.66 in West Texas Intermediate. That's up $1.11 or 1.36%. Now, I mentioned the Black Sea this morning in my live stream. I didn't have all the information yet, so I didn't get into it on the live stream. But let's talk about this because there was another thing happened last night. Ukraine attacks Russian naval vessel in first threat to oil infrastructure. Moscow downplays the scale of the damage caused by a drone strike on infrastructure and the army base at Novorossiysk. Tell me, how is my pronunciation? Novorossiysk. I'm working on my non-regional diction. Well, the city of Novorossiysk is this. Oh, go ahead, Mish.
Yeah, I was going to say it wasn't too bad of a pronunciation.
It wasn't terrible? All right. Well, good. I thought I butchered it, but in Novorossiysk is where this is a Rapucha-class landing ship, was hit by a Ukrainian drone. It wasn't an aerial drone. It was a naval drone, basically a remote kamikaze boat that just drove right into this. There's video of the attack. I'm not going to show video of sailors getting killed on this channel, so if you can go look at that if you want to. I just don't want to show that. But this is the ship, the Olenegorsky Gornyak, was hit. That I'm sure I butchered. It's a Rapucha-class landing ship that was standing guard over Novorossiysk. Let's talk a little bit about this attack. Ukraine threatened the oil export infrastructure that helped fund Moscow's invasion for the first time, using a drone strike to damage a Russian naval vessel outside the port of Novorossiysk. Let's scroll down a little bit and get to the financial impact. Not to belittle the human impact, but this is a finance channel, so we're going to stick to that. Novorossiysk is Russia's main Black Sea oil port, exporting about 600,000 barrels per day. That's a lot of oil goes through that port. It's also the main export point for oil from Kazakhstan, with the 1.2 million barrel per day line from the Caspian Pipeline Consortium terminating there. So a lot of oil flows into this port of Novorossiysk. The CPC, in which U.S. oil major Chevron holds a stake, said there had been no damage to the pipeline or the infrastructure. But this is interesting here. Anything that risks curtailing Russian oil supply to the market is not going to be welcomed by the White House, said Halima Croft, a former CIA analyst who runs commodities research at RBC Capital Markets. She added that one worry for Washington was that the Western support for Ukraine would be harder to sustain if there was a wider energy crisis. So this is kind of interesting, guys, because remember the sanctions and the price caps on Russian oil. Now what they're saying is, well, if they start attacking the oil infrastructure, now you're messing with a certain somebody's poll numbers because of higher gas prices. That might not make you so simpatico with Washington, D.C. So that was interesting. And, you know, ever since the Russians started targeting the grain exports in the Ukraine, especially along the Danube River, which, by the way, let's bring that up. Here's the map, right? I don't know if you guys remember the live stream where I kept referring to Romania as Poland, and I was correctly called out in the comments for that one. Yeah, that stream. Here's where the Russians have been launching a lot of missile strikes at the port of Odessa and at these other ports along the Danube River here, which borders with Romania, not Poland, and that was limiting a lot of the grain trade out of Ukraine. Now, I theorized that the Ukrainians might retaliate against this shipping lane. You can kind of see this line that's made up by all of these boats. This is on marinetraffic.com. Every one of these arrows is a ship carrying either oil or grain or something, and I was wondering, first of all, do the Ukrainians even have the capability to hit this shipping lane? Well, the answer to that is clearly a resounding yes, because they sailed one of their drones somehow from over here, the Ukrainian bases, all the way around Crimea, all the way here to Novorossiysk, which is where the attack was. And you can see, guys, this whole big line of ships here moving all the way across the Black Sea through Turkey into the Mediterranean. It all goes to Novorossiysk. This is a very busy port. You got a lot of grain and you got a lot of energy flows out of there. So this attack puts those supplies at risk. And, well, that means oil prices are fair game. And I was wondering, most of my focus when I talked about Ukraine's potential retaliation, I was saying I'm not so sure they would do that, because if they start hitting grain shipments out of Russia, well, that's going to drive up global food prices, and that's something that would cost them support in the West very quickly. If we see food prices going higher and people starving in the global South because of a Ukrainian counterattack, then, well, all of a sudden, support for funds and missiles and everything else to Ukraine dries up real fast if you start doing that. I never considered they might hit the oil infrastructure, and that's exactly what they did. So keep an eye on that. And by the way, check out this. This is the ship that was hit there. This is that Rapucha-class landing ship in this video. You can see it here, listing really hard to port. What it looks like is the Russians ran this thing up on the beach, ran it aground to try to keep it from sinking and try to salvage the ship. But clearly a big impact from that drone strike. Again, I'm not going to show the drone strike itself. But let's take a look at oil prices here, guys. Because
before we move on to oil, Grandpa's in the chat.
Grandpa's in the chat? Well, hello, Grandpa. And thanks again, Grandpa. I missed Grandpa's super chat in my live stream yesterday morning. And Grandpa, I did circle back this morning in the live stream, on my daily live stream, so I did answer your super chat question. Thank you, Mish, for calling that one out. And thanks again, Grandpa, for your support. And I'm sorry I missed that one in my haste to end the stream yesterday. Now let's look again at oil prices here. You can see we regained the 200-day moving average. We came up a few weeks ago. We rejected the 200-day moving average, but on our next attempt, we broke through. Now we're approaching this line right here. This is the previous high that we saw in April. Let's zoom in a little bit here. You see we came right up to that April high today, rejected that line, and came back down. So now this looks to be the resistance line as we move up. If we break above this, where I drew it was about 83.36 for West Texas Intermediate. We break above that, and we're off to the races for the next level of resistance, which, I don't know, probably wouldn't be anywhere until the low 90s, maybe around $93 if we break above that. So watch that 83.30 level. We got to close above that. That means oil is heading back to the low 90s. And speaking of heading back to the low 90s in oil, guys, the Baker Hughes rig count. Better part of 2 months now, I've been warning about this, all right? This is not a drill. Literally, hey, pun intended, this is not a drill. I didn't even get that, or pun not intended, but I'll take it. Another, 4 oil rigs shut down this week in the Permian Basin. This is such a huge deal, guys. This is U.S. domestic oil production in decline. Now, the oil production itself is not yet falling because these are low-performing wells that are being shut down. and the wells that are operating are increasing their production. But that won't hold for much longer. Oil is dependent on a never-ending flow of capital expenditures, of investment in new rigs and new projects, and there is a delay in these things. It takes a while from the moment you poke a hole in the ground and then put the rig up before it starts producing. We're not investing right now in new rigs. The prices are too low. And, of course, the political nonsense that goes on in the airwaves, we talk about our oil companies like they're Satan incarnate. So, of course, they're not willing to invest money in somebody else's poll numbers, not when they could just pay out higher dividends and keep more money for themselves. So our oil companies are not investing in new rigs right now. And for the better part of a couple of months, look at this, week after week. Back in May, we were at 575. And now we just keep every week, another few rigs disappears every week. Now we're down to 525. Almost 10% of U.S. oil rigs shut down in the last 2 months alone, guys. Sooner or later, this is going to hit domestic production. And how much you want to bet? That's not going to come when oil prices are at $67 a barrel. No, this is going to start impacting production when oil prices are back over $100 a barrel. This is a very big problem. We need to change the narrative around the oil companies. We need to change how we license and permit these things. I thought when we suspended the debt ceiling, part of the deal that the Republicans supposedly held out for was going to be to streamline permits and pipelines. Well, I don't see it. I still see oil rigs shutting down. This is going to blow up in our faces. We're going to get higher oil prices right as our rigs are all shut down, and we will be caught offsides once again, not producing oil of our own. So this Baker Hughes rig count, keep an eye on this, guys. This is a big deal. But let's get to the story, that the highlight of the live stream. The Fed, okay? Always the Fed. All roads lead to the Fed, don't they? Well, I talked about this morning after the jobs report that we were probably going to start to see some jawboning, that the Fed was going to march out, trot out their Fed officials. Well, that's exactly what they did today. Fed officials tout job market slowdown and seek to pivot from hikes. Think about this for a second, guys. These guys are out there pounding their chest, congratulating themselves on a job well done, when the job that they're doing is to destroy the labor market. That's their goal. And they're saying you're welcome. Just think about that. The way they solved the inflation problem that they caused, that made they rich, is to put you in the poorhouse. And they're saying, you're welcome, we did a good job. The debate is to shift from how high to hike rates to how long to hold rates. Atlanta and Chicago Fed speaks in Bloomberg TV interviews. And right there, that is Raphael Bostic. He's the head of the Atlanta Federal Reserve. By the way, he is also on the short list to be the next Federal Reserve chairman to replace Jay Powell. God help us if that happens, because he is an uber dove if they put him in charge. Two Federal Reserve officials said slower U.S. employment gains suggest the labor market is coming into better balance, arguing the central bank may soon need to pivot to thinking about how long to hold interest rates at elevated levels. I expect the economy to slow down in a fairly orderly way, and this number, 187,000, referring to the headline jobs number from this morning, comes in continuing that pace. Atlanta Fed President Raphael Bostic said Friday. Mr. Fed Bostic, Mr. Fantastic. Television's Wall Street Week with David Weinstein, he said, referring to the July hiring figure in a monthly jobs report published earlier in the day. I'm comfortable, he says. I'm not expecting this to be over in a short period of time, Bostic added in a reference to the slowdown, suggesting he doesn't see any need for additional rate hikes. So some very dovish comments from Raphael Bostic. Now, we also got Chicago Fed President Austin Goolsbee, poor guy with a name like that, Mr. Goolsbee, speaking in a separate interview with Weston. He said policymakers will need to be patient through the disinflation process and is hopeful the central bank can bring inflation down to its 2% target without causing a recession. Yeah, right. This soft landing nonsense, it is unbelievable that they're still talking about the possibility of a soft landing with some of these numbers that are going on in the economy. They will soon need to start thinking about when to hold interest rates steady and for how long. Rather than arguing about the peak rate or how many more rate increases do there need to be, what we should probably start thinking about is how long does this last that you're going to be at these elevated rates, Goolsbee said. So the pause, that's what they're talking about here, guys. They're saying how long is the pause going to be? We've got Bostic and Goolsby saying we're done hiking. Now, how long do we pause for? Now, I got to throw a little hawkish cold water on their dovey parade because let's keep this in mind. And shout out to InTouch Capital Markets who put this chart together. This is all of the Fed governors, the Fed presidents, and where they rank on the hawk-dove scale. Now, for those of you who are newer, a hawk is somebody who is all about self-control and restraint. A hawk wants higher interest rates, wants less debt spending. A hawk wants less of the Federal Reserve propping up asset bubbles. Whereas a dove is more of a soft, let's print money, let's buy bonds, let's keep interest rates low so we can nurture the economy, let's make the asset bubbles worse. Well, you'll see here that Bostic and Goolsby, all the way at the top of this chart, they are the two most dovish of all of the Fed governors. So I'm not reading too much into Bostic and Goolsby's comments today that they're done hiking because these are two guys who would be saying that anyway. They've always said this. They've always been doves. So dove's going to dove, hawk's going to hawk. I want to hear from Kashkari all the way down here in the red. What's Kashkari going to say? What's Waller going to say? What's Mester going to say? Now, if one of them comes out and says we're done hiking, that you better pay attention to. That's something that might move markets because those are hawks. They're supposed to be saying, no, raise rates, kill them all. That's what those guys say. By the way, Bullard all the way at the bottom down here, James Bullard from the St. Louis Fed, he's out. He announced his resignation. He is leaving the Federal Reserve. So just his absence alone, him leaving, is a dovish shift for the Fed because he is the most hawkish voice of them all. Now, let's talk a little bit about why I think it's an inevitable that Burr come back. And this is from Luke Groman, who retweeted Michael Taylor on Twitter today. First, let's talk about what Luke is saying here, and this is a pretty good analogy. Luke Groman is saying the U.S. debt downgrade, that's where the puck is, where it was. Here is where the puck is going. All right, now he's referring to a very famous quote from Wayne Gretzky about, what he used to say, why are you such a good hockey player? He says everybody else chases the puck, everybody else skates towards where the puck is. Gretzky, he would skate towards where the puck is going to be. He would lead it. All right, so Luke Groman is saying let's think 3 moves ahead. Let's not talk about what's going on right now. The Fitch downgrade, the move higher in rates, that's where the puck is. Let's talk about where the puck is going. And Michael Taylor had a fantastic tweet here. He's saying with Mr. Rodney Dangerfield, I just crack up when I look at Rodney Dangerfield. He's a good-looking kid. Now I know why tigers eat their young. About 44% of federal debt, read that as $15 trillion, is sub 2 years in duration. Meaning $15 trillion of the government's debt matures in the next 2 years. Now, the government is not going to pay that back. They're going to renew it. They're going to roll it over, right? They're going to borrow new money to pay that old money, right? That's what they do. When their credit card gets maxed out, they just start another credit card and transfer the balance. That's how our government operates. They're that bad. But the thing is, remember, interest rates have risen. So all of that debt that matures, that less than 2 year in duration debt, that was borrowed at a lower interest rate. When that $15 trillion matures in the next 2 years, they're going to have to borrow money at a higher interest rate to pay back that lower interest rate debt. Now, you or I or any company, any person would go bankrupt in that scenario because you or I don't have a money printer. But the government has a Burr. And this is one of the reasons why we're saying the return of Burr is here. It's a mathematical certainty because as they borrow to pay off their older low-interest debt, they're taking on newer, higher-interest debt to pay that back, which means their interest expense is going to keep rising a lot over the next 2 years. $15 trillion of debt coming due.
Okay.
Now, along with that, you've also got about $2 trillion plus of commercial real estate debt coming due, maturing. Much of that is currently negative in NPV, which net present value, which means this commercial real estate debt, again, low interest debt taken out previously, it's maturing. The only way these buildings can be refinanced is to take out higher interest debt to service that, to pay it back. Well, higher interest debt means the payments go up. I did a video with Mallmageddon in the thumbnail if you want to check that one out, all about how malls across America, malls, retail buildings, office buildings, they're all going default. They're all going belly up. The owners are just handing the keys back to the bank and defaulting on the loans because they can't afford the higher interest rates. $2 trillion of that in the next few years matures. He's saying, in my humble opinion, it's very likely to witness a return to QE and yield curve control before the year end of 2025. I do not see a probable mathematical alternative. And then we get Mr. Rodney. It's a matter of time. It's a mathematical certainty, guy. There's so much expensive debt that has to be paid back, and they can't pay it back. The only way they can pay it back is by borrowing more high interest debt to pay back this low interest debt.
Hey, Jack.
Yes.
So right now, some of these numbers they're throwing out, they're saying, hey, we're going to offer $40 billion in 10 years. And then they'll say, but we're going to also refund, this much billion in 1 month. That refunding means they're rolling that debt over.
Yes. Borrowing new debt to take out old debt. Mm-hmm. Yeah. And the other thing to think about, guys, I talked about this in one of my morning live streams earlier this week. A lot of this debt that they're going to issue in the next couple of weeks is going to be on the long end of the yield curve, right? Like 10-year duration, 30-year duration, 2-year duration. That's the stuff where if they issue too much debt over there, let's think about this in terms of supply and demand, all right? When the supply goes up, but the demand doesn't, the price goes down, all right? So the Treasury, Janet Yellen, she's going to issue all of this long-term debt. She's going to drive down the value of long-term debt. But remember, with bonds, price and yield are inversely correlated. So as they drive down the price of those bonds, they're driving the interest rates higher. So they're making their borrowing cost problem worse with all of this new debt issuance. And this is why we keep saying liquidity is a problem. If there are not new buyers to step in and buy up these bonds, then the prices are going to collapse and the interest rates are going to spike. And right now, all of the biggest owners of U.S. government debt, all the major players, they're sellers right now. They're all selling debt, driving the price lower. Joe Brown over at Heresy Financial did a video about this. He released it today. Japan, the largest holder of U.S. government debt outside of the United States, they're net sellers of U.S. government debt. China, the second biggest holder of U.S. Treasury bonds outside of the United States, they're sellers. They're dumping U.S. debt. The single largest holder of government debt in the world, in the freaking universe, the Federal Reserve, they're doing quantitative tightening. They are net sellers of U.S. government debt. All of the biggest players in the bond market right now are selling. That means all the pressure on interest rates is up. And that means the cost of servicing that $32 trillion debt load is on the rise. And shout out to, who is this again? This was Mr. Jesse S. White on Twitter at JCath36. He put out this video today. This is fantastic. I'm going to take you guys through this thing because this is so good. We start in the 1940s. All right, watch as we go this. This is U.S. government interest payments. As we approach $1 trillion annually, look at the visualization of this, all right? We're starting in the 40s and the 50s here, right? Okay, the interest expense, $6 billion, $7 billion. It's on the rise. It's going up. It's going up. Okay. Oh, we had a big jump up in the 1950s and the 1960s. We got the space race. We got the Cold War. 1965. Now that happens in 1965. That's right after 1964. We took the silver out of the money, right? And then Charles de Gaulle starts to get concerned about all of the dollars that are piling up in Europe. And he says, you know what? I'm starting to think Uncle Sam's not good for it. So France, we want our gold back. That all happened in 1964, 65. Now look at what's happening to the interest cost on U.S. debt. Oh, it just went vertical, didn't it? Now it's at 34.7, $35 billion in U.S. debt. Oh, but wait, now we've got the 1970s coming up. Uh-oh. Here's Paul Volcker fighting inflation. Look at the interest expense on U.S. government debt through the 1970s and into the early 80s. Look at what happens. Now we're over $200 billion a year. But they defeated the inflation. They did do that. They brought the inflation under control. And, of course, they crashed the stock market and the real estate market and everything else. The early 80s was a horrible time. You guys may recall. It was before my time. I was just a wee lad in 1980. But now we go through the 80s. Look, the interest expense continues to rise. It continues to go vertical into the 1990s. Wow, even during the Clinton days, we didn't do so well. And what was that there? You see what happened just now? The interest expense in the U.S. went down. It went down from a peak of almost $400 billion down to $299 billion. What happened? Did the U.S. debt get smaller? Of course not.
Actually, it did. Sorry to blow your narrative, but in the 90s,
the Clinton
it did go down just a little.
The Clinton surplus. Yeah, okay. I'll give you the Clinton surplus. But the size of the Clinton surplus, this going down was not the Clinton surplus. This going down was the dot-com bubble bursting and the Federal Reserve, in a panic, lowering interest rates to prop up the economy. That's why that interest expense went down. This was 99, 2000, 2001. That was the dot-com bubble bursting, right? So, yeah, under Clinton, we did have a surplus, but the debt didn't get sizably smaller, not by any. It was a drop in the bucket. Now, it was a surplus, though, and if we want to go back to that, sign me up any day. Any day, I'll take that. But let's keep playing here. Let's see what happens. Because, okay, now the debt starts rising again. Now, what was that again? Hold on. Why did it go down again? What happened? Oh, that's right. That was 2007, 2008. That was not the debt getting smaller. That was the global financial crisis. And once again, the Fed panicked and they lowered interest rates to fight the GFC. So the only time our interest expense goes down is when the Fed panics. It doesn't go, I mean, the debt just never gets smaller. It did, as Mish pointed out, for a brief moment. And of course, then we had the Obama years and the Bush years, and all they did was borrow during the Bush years and the Obama years. So look, the debt just keeps going higher, bounces around a little bit, QE1, QE2, QE3, and now through the teens, the debt goes up. But what happens here? Look, we had another decline in the interest expense. Oh, that was the vid. Right? That was the disease that I shan't mention by name at risk of getting my channel in trouble. The interest expense dropped because, again, the Fed panicked to prop up the economy and they lowered interest rates. And so the interest expense on the U.S. government debt went down. But we didn't use it to get out of debt. No, we just doubled down on spending. So watch that interest expense. It starts to rise again. Oh, my God. What was that? That vertical was the last 12 months, guys. That vertical line there. We just went from 1945 all the way through to today. Look at what just happened to our interest expense. $970 billion over the trailing 12 months. And look at how fast it's rising. Now, the whole government takes in something like $6 trillion a year in taxes. So at the current pace, at this vertical line straight up, within a few years, just the interest on the debt will exceed all tax revenues. We can't keep interest rates here. It's a mathematical certainty. It all breaks if we stay here. Companies go belly up. Commercial real estate pops. Housing pops. The stock market crashes. The government defaults on the debt, not because of a standoff, but because they just don't have the money in existence to pay all the interest on that huge debt pile, not at those interest rates. And the reason I point to this is because what is going to happen here before we get to that, maybe not before we get to all of that, but some of that will happen. The Fed will lower interest rates again. We'll see a return to ZIRP, zero interest rate policy, just like we had these dips before, which were not debt getting paid off. That was interest rates dropping. It's a mathematical certainty the Fed is going to lower rates. I can't tell you when. If I could tell you when, guys, I'd be a billionaire. I wouldn't have to do this. But it's going to happen. The numbers don't lie. The numbers, they've gotten too big. We cannot afford 5% interest on a debt pile of $32 trillion. It's just more money than we have. And keep in mind, guys, even if we balance the budget tomorrow, which is a pipe dream, a fantasy, that's not going to happen. But even if we balance the budget tomorrow, where the money the government spent on everything, the military, social programs, entitlements, welfare, all of it, the Department of X, we would still be adding $970 billion to the debt just on the interest of the $32 trillion we've already got. It's only a matter of time before interest rates get lowered.
Okay, Jack, we're at 4 deep.
We're 4 deep. All right, let's bring up a couple of these super chats. We've got Mr. Kevin DeBella's in the house. Thank you, Kevin, very much, sir, for the super chat. He's saying, just saying, thanks for your effort every day and happy Friday. You are most welcome, Kevin DeBella. It is truly my pleasure. And thank you, sir, for watching and for your support of the channel. And a happy Friday to you as well. I appreciate that very much. Crypto Canvas, what's going on? Thoughts on Fed Now? Thanks, my brother. Oh, boy. Oh, boy. Fed Now. Okay, here we go. You knew this was coming, right? You're going to bring up Fed Now. So, all right, Fed Now. The inevitable result of a return to zero interest rate policy, the inevitable result is going to be inflation. All right, the last time we returned to zero interest rate policy because of the vid, and they did the QE and they printed money to buy bonds to lower the interest rates to prop up the economy. Surprise, surprise, that caused inflation. All right, so they're going to do it again. We know they're going to do it again. It's just a matter of how much pain do they expose us to in the process, right? My personal opinion, I think we'll see deflation before this happens. I really do. But I don't think we'll see prolonged deflation because they can't tolerate it because the debt is so big. So when they go back to zero interest rate policy and when they start up QE again, they are going to light a fire under inflation. And inflation is going to come roaring back like we couldn't imagine. Now, when that happens, they could rinse, repeat this cycle. They could crank up interest rates again, crash the economy again, cause deflation again. They could just keep doing that. Or they've got a central bank digital currency. Now, Fed Now is not a central bank digital currency, but Fed Now is the plumbing of the central bank digital currency. Fed Now is as the Chicago Pile was to the Manhattan Project. And for the other nukes, the Chicago Pile was the first sustained man-made fission reaction on Earth. I say man-made because there were natural fission reactors underground billions of years ago, but there were. But the Chicago Pile was the first sustained fission reaction, and with what we learned there, we had the Manhattan Project that ultimately resulted in the bomb. In this case, Fed Now is the Chicago Pile, and the central bank digital currency is the hydrogen bomb dropped on a city. And what a central bank digital currency allows them to do is throttle demand. So now not only do they control the supply of money through the Fed, but they also control how that money is used. And guys, I'm telling you, this is not tinfoil hat. This is not a conspiracy. Their own words. They, with a capital T, the World Economic Forum, all right, the Fed guys, the IMF, Augustin Carstens, all right, all these guys have already told us what they plan to do with this. They plan to use it to control your spending, to control your life, your consumption, so they can just program your money based on your, I don't know, social security number or your eyeball. If WorldCoin is used to do this, who knows? But they can just switch off your money after they decide you've had enough gasoline this week. So that way they can control inflation, not by rigging prices, but just by saying, once you've bought 5 gallons, you're cut off. And now they've artificially destroyed demand by saying you, Jack and Mish, can't have any. And of course, they can have as much as they want because, like, I don't know, John Kerry, oh, I buy carbon credits and I fly around the world to fight climate change in my private jet, and therefore I should be allowed to consume all that extra oil. So they'll make sure they get enough. So a central bank digital currency is about throttling consumption. It's about controlling demand for everything. And they can also use a central bank digital currency to prop up demand for something. They could give everybody a stimmy and say this stimmy is only good for the purchase of an electric vehicle and it expires next month. So go ahead and use your Fed coins to buy an electric vehicle or you won't have them anymore. So what do you think that would do? People are going to run out and buy electric vehicles. That's going to drive up the price of electric vehicles. So they can use a central bank digital currency both to suppress inflation where they want it suppressed and drive it where they want it higher. And they've also said, you know, I forget the name of this muckety muck from the WEF, but they straight up said that they could use it to discourage undesirable behaviors, such as adult entertainment or the purchase of firearms-related materials. And I'm probably going to get myself in trouble here. I'm going to shut up now. But yeah, that's my take on Fed Now. I think Fed Now is laying the groundwork for a CBDC. It isn't a CBDC yet. It's not going to happen just yet. But first you create the crisis and then you offer the solution. Right now, the Fed is creating the crisis with the help of the Treasury, as shown in this chart. Fed now is them developing the solution. They're going to have it ready to roll out for when we beg them for it. And I'm telling you guys, when everything is failing all around us, it won't take much convincing to get people to say, yeah, I'll take my Fed wallet with the preloaded stimmies already in it. All I got to do is scan my eyeball at this stupid orb, courtesy of Sam Altman and his AI. I don't think that's so far-fetched, guys. It's the 2020s. Let's not put this past they. They have done much worse already in this decade. All right, time to throttle the tinfoil hatting this so I don't get myself in trouble again. I just broke out of this slump. Crypto Canvas, you're going to get me back in a... You're going to get me slapped by the algo again. Thank you, Crypto Canvas. I appreciate the support of the channel, sir. Thank you, Mr. Toad. The wet sprocket himself, he says, one of Hong Kong's home builders decided to sell brand new homes cheaper than second market homes. Last time something like this happened was 1998. You know, Toad, that sounds an awful lot like a conversation I had with Travis over at Real Estate Mindset last weekend. Check out that video. There is a video about that. What was in the thumbnail? Housing market. I forget what it was in the thumbnail, but I put it out. I think it was on Monday I published that video. And Travis was talking about almost the same exact thing about how new home sellers, I mean, they're artificially keeping the prices high, but they're doing things like they're slashing prices and they're buying down interest rates. Lennar offering 4.25% interest rate on a brand new home. So maybe the price of the home is higher, but since Lennar will buy down your interest rate, you can get into a new home for a lower monthly payment than you can get into a existing home now, because of what they're doing with the interest rates. So, yeah, we're seeing something similar going on here, Toad. That's a good catch. I hadn't seen the story out of Hong Kong. Remind me to ask Travis about that, because I am working with Travis right now to schedule another sit-down to do another housing market update. So I will ask him about Hong Kong and selling brand new homes for cheaper. I'd never heard of that one. Good stuff, Toad. Thank you, sir, very much for the thought-provoking comment and the support of the channel. And thank you, Mr. Edward Diaz. Says, which one makes the Fed pivot? Unemployment rate going above 7 or markets dropping by 25 to 30% in an uncontrolled fashion? I don't think it'll be unemployment, Edward. They might say it's because of unemployment. They might claim it's to help the common person. But keep in mind, right now, they are crushing the common person to preserve the profit margins of the companies that they inflated through their money printing. All right, so... You know, Lynette Zhang said it best in my interview with her this weekend. Their main job is to preserve their job. Their job is not to preserve your prosperity, your well-being. So they, capital T again, they will do what keeps they in power. And that usually is not good for us. And they usually tell us it's for our own good, but everything they roll out is almost always at our expense. Case in point, the bailout of Silicon Valley and Signature banks. They could have let those banks go belly up, and it would have hurt. There would have been a lot of pain. But you know who would have lost a lot of money? Venture capitalists in Silicon Valley, who have a lot of favors to call in Washington, D.C. They would have lost a lot of money. They with a capital T. So instead, they got the taxpayers to pick up the tab. So they socialized the losses. They told us it was to preserve jobs and to preserve the banking system, and, oh, we acted quickly and decisively to preserve the common prosperity. You're welcome. But really, they screwed us to preserve the wealthy. That's exactly what they did in March, and I think they'll do it again. That's why they'll pivot. It'll have nothing to do with unemployment. Now, unemployment may coincide with they starting to lose money, like more banks failing. Like when enough small banks have failed, when the regional banks have failed, and JP Morgan and Bank of America have bought them up, that's when they pivot, right before the pain gets to that upper echelon of the banking system. Once the big banks are big guys are under threat, oh, they'll pivot like that. Instantly. So thank you very much, Edward Diaz. Appreciate the super chat, sir, and the support of the channel. Thank you, Dan Hedin, Dan the man. Thank you very much, sir. He says to help with you getting in trouble. I don't know if I got myself in trouble yet. I think I'm still clear, but I am grateful for the help anyway, Dan. Thank you, Jack. Please like and subscribe if you feel so inclined. Look at that. What a guy. He gives me a super chat and he pumps engagement for the algo. Thank you. Awesome, Dan. Very much, sir. I appreciate that. Dan, by the way, is also among our Patreon group. So link down below to that should you feel inclined. We get together on Patreon once a week on Wednesdays at a different time every week so that we can accommodate people from other time zones. And if you can't make it, we also post the recordings after the fact so you guys can catch up. But we do an open Q&A once a week on Patreon. Thanks a lot, brother. I appreciate that, Dan. All right, guys, let's move on a little bit from this story. How we doing? 410. Markets are closed. Let's go look. We ended up closing down 22 points or 0.5%. In the S&P at 44.79, the Dow ended up closing down 150 or 0.43%, 35,065 for the Dow. And the NASDAQ down 0.36% or 50 points. What a swing, man. The NASDAQ was up almost 200 points at one point today. Ends up closing down 50. So big reversal. Again, I still don't know what happened at 13:50 Eastern time today. I don't know what it was that made all those markets turn on a dime, along with the US dollar index that turned right around 1350 today. Something happened that spooked everybody. I don't know what it was. If I find it, I will certainly bring it to you fine folks. All right, let's also talk about this one, the Fed's balance sheet, because every time we saw that decline in the interest rate expense chart, remember this video that we watched a few minutes ago? Every time we see one of these declines, do you know what also happens? We see a corresponding increase in this chart, the Federal Reserve's balance sheet, because they don't just lower interest rates when things get tough, when the economy crashes. They don't just lower rates in a panic and thus lower the interest expense of the federal government. They also, starting in about 2008, they also start to quantitatively ease because the debt pile has now gotten so big. The problem is now so big that lowering interest rates to zero is no longer enough. So what they do is they also print money, and they use that money to buy government debt. And when you buy government debt, what do? You drive the price higher. You drive the interest rate even lower. So that's another thing that the Fed will do because we beg them to. Not only will they ZIRP, but they will also burr. They will ZIRP and burr. And I'm sure there's like a T-shirt slogan in there somewhere, ZIRP and burr. I don't know. Just sounds catchy to me. So let's talk about a couple of indicators that why I think that's coming. We're going to blow through these because we've been going for a while. Maersk warns of slower demand for container shipping. Maersk, one of the biggest shippers, that global trade, guys, is grinding to a halt. And this is a global thing. Yellow Trucking just went for bankruptcy on Monday. 30,000 people out of work. That will show up in the unemployment rolls eventually. It's going to take a few weeks before it shows up. But it's not just a U.S. on-the-road shipping kind of thing. It's also happening globally on the high seas. CEO Vincent Clerc said he saw no sign that the destocking, that's American companies burning down their inventory by not ordering new stuff, which has curbed global demand, would end this year. He sees no sign that's going to end this year. In other words, Christmas was just canceled for a lot of retailers, for a lot of people who manufacture and ship goods. They're not seeing any reorders of inventory. They were expecting it, but it never showed up. We had expected customers to draw down inventories around the middle of the year, but so far we see no signs of that happening. It may happen at the beginning of next year, Clerc said in a media briefing. Consequently, the uptick in volumes we had expected in the second half of this year has not occurred. So all of these shipping companies, guys, they were expecting the soft landing. It never happened. Nothing's moving. Nobody's ordering stuff, and so factories aren't making stuff, and so there's nothing to put on the boats. Maersk runs the boats, and they're saying there's a problem. The rebound is not coming. We also see it in Germany. This one just hit the tape. Lanxess, I don't know if I'm saying that right. Lanxess calls for government help for the chemical industry after profits slump. Chemicals group Lanxess on Friday set out plans to trim costs, including job cuts, and called on German politicians to support the struggling industry after its quarterly profit fell by more than half. This is a big chemical company in Germany. Now, what are they saying? They're saying we're going to cut costs. We're going to close plants. We're going to lay people off. We're going to trim our expenses, but that won't be enough. We need government support. You know what government support sounds an awful lot like? It sounds an awful lot like ZIRP and burr. Sounds like lowering rates. It sounds like printing money. Now, this wouldn't be in the Fed's purview. This is more along the lines of the ECB, Christine the Felon Lagarde over at the European Central Bank. No, it would be in her purview. But once again, it shows that when economic times get tough, they start crying for help to the government. They say lower interest rates, keep my cash losing business alive. And, you know, this is a company that's really being driven down by the absurdity of European energy policy, which, to be honest with you, I hate to say it, they should be grateful because they dodged a bullet in the winter. It never really got that cold in Europe this winter, and that's the only reason Lanxess is even alive today to ask for government support is because they didn't go belly up in January when they should have. Because the Europeans, they put Greta Thunberg in charge of the energy policy. All right, let's see how many electrons Greta can move. She can't. How dare you? Sorry, Greta. Here's another sign things could be getting closer to ZIRP and Burr. Open Door and Redfin stocks tumble on weak outlooks. Uh-oh. Open Door and Redfin, what do those companies deal in? Housing, real estate. And their stocks are tumbling. Shares of Open Door Technologies and Redfin fell by double-digit percentages on Thursday after the real estate-related companies provided financial guidance that was markedly lower than expected. Now, the company's earnings were halfway decent, but their forecasts were weak. So that goes to show you that Open Door and Redfin, they're arguably, you'd say they're tech companies, not real estate, but they're tech companies that deal in real estate. They're saying there's no earnings coming next quarter. They're going to be lousy, which means that they anticipate a thawing of the real estate market, which is currently frozen in place, but it's going to thaw to the downside. They're saying housing is going to crash. Maybe they're not using those words. I might be taking this and going to the next level with it. But suffice it to say, Open Door and Redfin stocks getting crushed. That doesn't say good things about the housing market, that's for sure. Check this out. Open Door down 26% today, trading at $3.54. And Redfin stock down 24.3% today, trading at $10.85. Real estate stocks getting crushed, guys. Not a good sign for the housing market. Why? Because we are watching a death spiral, and the housing market is propped up by debt, by low interest rates that are long gone now. Last one I want to talk about, this story, we're going to have to put the tinfoil hat back on for this one. Sorry, guys. WorldCoin says will allow companies and governments to use its ID system. And shout out again, who is that? Crypto Coins or Crypto Canvas. Thank you, Crypto Canvas. Again, thoughts on Fed now? Well, let's talk about WorldCoin. Because remember, WorldCoin, I did a video about this one. This is the new altcoin that all you got to do to get their free stimmy, their free WorldCoin, is stick your face in their orb where it scans their eyeball, and then you get a digital wallet tied to your biometric data. Central bank digital currency, maybe? Tied to your biometric data, and then they'll give you some free stimmies. Stimmies to adopt a new coin. Interesting, based on your biometric data. And, well, they promise they're going to enforce your privacy, right? All of their statements from WorldCoin talks about how privacy is so important. They're not going to share it with any third parties. Don't worry. Totally safe and secure and in-house. We don't even store your biometric data. We delete it as soon as we have it. And then a week later, they say, we're going to let companies and the government have it. Boy, that changed real fast, didn't it? Now, let me just tell you guys that when somebody gives you something for free, when you're using a product for free, all right, like Facebook, like even YouTube, for example, right? When they give it to you for free, that's not the product that they're giving you. When they give it to you for free, you are the product. It's important to keep that in mind. So when they scan your eyeball and they give you the free WorldCoin, they're not giving you anything. Your eye scan, your biometric data is the product that WorldCoin is buying with that stimmy. And they're selling it, guys. That's the whole point. Again, tinfoil hat. The whole point of WorldCoin is not this new altcoin that's going to revolutionize or democratize finance or anything. No, the whole point is to get your biometric data en masse in huge quantities so that they can sell it. That's their business model. And this technology would be perfect for a central bank digital currency. And I just want to scroll down a little bit here because companies could pay WorldCoin to use its digital identity system, for example. If a coffee shop wants to give everyone one free coffee, then WorldCoin technology could be used to ensure that people do not claim more than one coffee without the shop needing to gather more personal data. Remember when I said how a central bank digital currency could be used to stimulate demand? How they could give you a stimmy and say it's only useful to buy an EV and it expires? Well, that sounds an awful lot like this hypothetical, purely fictional coffee shop scenario, doesn't it? The idea is that as we build this infrastructure, that we allow other third parties to use the technology. Well, Sam, you just told us you weren't going to do that last week. You told us you were going to preserve our privacy. I thought we were in the trust tree in the nest. What happened? All of a sudden, you're selling us. In the future, the technology behind the iris scanning orb will be open source. It already is. The idea is that anyone in the future can build their own orb and use it to benefit the community that it's aiming for. So they're giving away the orbs for free too. Why? Because the orb is not the product. You are the product. Your eye scan, your biometric data is the product. And of course, there's privacy concerns. Regulators and privacy campaigners have raised concerns about WorldCoin's data collection, including whether users are giving informed consent and whether one company should be responsible for handling the data. WorldCoin's website says the project is completely private, even though they just told us they're selling it to the government, and that the biometric data is either deleted or users can opt to have it stored in encrypted form. Yeah, right. So guys, if you ever see one of these things, one of these stupid orbs, don't stick your face in it. Yeah, I shouldn't have to tell you that, but you know, there's a public service announcement. If there's one thing you take away from my stream, don't stick your face in the orb. That's bad, okay? And last but not least, I got to say thank you to Mr. Edward Diaz, Johnny Walker, or Jack Daniels. I am partial to the me and Coke, as I call it. I am a Jack Daniels guy. Come on, you know me. I live small. I don't go for the top shelf stuff. I'm a bottom shelf kind of guy. I am a simple man. I have cheap tastes. I just like my YouTube channel. I like my house. I like my family. That's how I roll. Fine wines, fine drinks, fine liquors are wasted on me. Honestly, if we ever meet, if we get together in Vegas and we have a drink, get me something cheap. I don't mind a cheap beer and bottom shelf alcohol. Don't pay up for me. It's wasted on me. I will be just as grateful for the junk as I am for the good stuff. But thank you very much, Edward Diaz. I appreciate the super chat and the support of the channel. Thank you, everybody, for spending your afternoon with us. We've been rolling for quite a while now. I think we're going to wrap this one up. Mish, you got anything you want to add, brother, before we call it a day?
No, I think just volatile is the word I'm going to use. Look for volatility over the next week or so. It's going to be interesting.
Yeah, you know, we don't talk about the VIX much on this channel, but we did see a move up in the VIX this week. And, well, if you guys want to read about something over the weekend, read about Volmageddon. I think it was 2018 or 2015 was Volmageddon. The short volatility trade was so fashionable. It was like this free money, easy thing. And a lot of funds got blown up on Volmageddon because everybody thought volatility was low and it was going to stay low forever, kind of like it's been for the last few months. And so everybody went everybody went short vol to collect premium on it. And then volatility came flooding back and a lot of people got blown up by it, lost everything. Good insight, Mish. Thank you very much, sir. And thank you, everybody, for spending your weekend with us. As I always say, hard times are coming, but they are not here yet. So enjoy this weekend with your loved ones. Give your kids a hug and a kiss. Say hi to mom and dad like I do. Hi, mom. Hi, dad. I love you guys. And everybody, until next time, live small and dream big.